Hi, welcome to Bond Bytes, a daily bond market highlights from INR bonds. And in this Bond Bytes, we focus on the RBI policy review that happened today. The RBI came and said that in their policy meet, they have decided to continue with the record low interest rate policy, as well as keep making sure that there is enough money available for the economy to grow. And this is a slight moving away from what global central banks like Fed and Bank of England and even ECB are now doing in terms of raising rates because of high inflation. RBI painted a rosy picture of the economy, but it remain, and also they have slightly nudged the bond market to be more responsible towards taking up government bond auctions. But even then, now with the lack of strong guidance on policy and being a little bit over optimistic on the macro front, given global headwinds, the bond markets, how will they absorb the supply? It's a problem. But what it has done clearly, I mean, after the policy government bond yields that had shot up after the budget, the 10-year yield had shot up to 6.95%, has fallen down to 6.7%. That's largely back on short covering. But the question is, as supply, whenever supply comes in, where will the market want to take in the government bonds? Given that there are still more uncertainties on inflation and many other aspects, which the RBI has not really focused on, but the bond markets are concerned. And so it remains to be seen whether RBI can hold on to interest rates, even at slightly below levels from highs, from peaks. But the reaction of the bond market and the Sensex and Nifty were positive. The INR slightly came down as interest rates were left unchanged. The main focus on RBI is the liquidity management. So there is over rupees 6 lakh crores or 6 trillion or close 7 trillion or rupees 7 lakh crores of money that is floating in the system currently. And RBI believes that focusing on this liquidity and making sure it's not going to inflationary to create inflation is their main target. And they are undertaking various open market operations to keep this liquidity in check. Having said that, what it clearly has done is allowed the corporate bond market to go and access the bond markets for corporate bond issuers to go and access the bond markets to raise funds for their investments and working capital. Now, because with the heavy government borrowing hitting the markets next year, then the corporate bonds could face problems because of the fact that they will be competing with the government and the state government for funds. And typically government and state government gets preference given a lot of in the bond market. And if corporates finding it difficult to raise funds, then you would have a problem of the private sector funding economic growth. So with keeping rates low, RBI has allowed the corporate bond issuers to hit the market and raise as much of funds as they can before interest rates start to rise officially. And so we should expect to see a lot more corporate bonds coming in. Retail investors clearly have started to invest in corporate bonds, and they could have a lot more options with various maturities and various interest rates, which could yield them better returns, beating inflation, and also have new bonds to issue in, to invest in, as more and more issuers come to the market to borrow funds. Don't forget to log into our Twitter Spaces at 8 p.m. today, where I will discuss interest rate cycles and where to invest for investors. And also do not forget to download our Quick Invest by INR Bonds app, where you can get the best bonds to invest in with the most information, the best and the best bonds that are most suited for your portfolio, and with a very seamless and straight-through investment process. The downloads available for iOS and Android, and the link in the description gives you the takes you to the download, as well as do not forget to subscribe to our YouTube channel if you have not done so, and do press the like button.